But I just wanted to say hello to everyone. My name is Sophie Shrubsole. I'm one of the team at Westminster Business Council. And for those of you that are here for the first time, Westminster Business Council is a connections agency and we operate right across central London. And because we're virtual, we also operate nationally now, which is fantastic. So I'm saying hello from Warwickshire. But Westminster Business Council helps just over 3,500 businesses connect, get to know each other, access really important information like we're doing today. So thank you very much everyone for joining us. Now the style of this event is very much interactive, so we've got two great speakers with us today tackling some really important issues, but if there are questions that you'd like to ask them, please do jump into the conversation. Just unmute yourself and say hello and ask your question. If for any reason you're having some technical issues, like your microphone's not working, there is a chat button just on the top right hand side. You'll see a little chat bubble. I will just say hello to everyone so you can see it pop up. So feel free to use that. But this is a good opportunity for us to interact and also hear from some great speakers. So today we've got Steve from Anthony Batty & Co. Steve is waving. Steve's a licensed insolvency practitioner, and we also have the lovely Clair Dart from Elliott's Accountants, and she is a tax specialist. But before we go to Steve and Claire, I just wanted to introduce Lena Liu of the L Factor, who is one of our fantastic members and a great part of Westminster Business Council. In fact, I think the Duracell bunny was basically invented when someone met Lena. She is amazingly proactive, and one of the reasons that we partner with her is that she really embodies the ethos of Westminster Business Council, and that's about connecting people to leverage partnerships and help grow businesses. So if anyone is wanting to get some support with their business, whether that be through strategic advice, but definitely through understanding partnerships and benefits of partnerships, please do contact Lena, and I'm sure she'll put her details in the chat box as well. So before we go over to Steve and Claire, I did just want to give Lena the chance to say hi to everyone first, and then we'll get on to the main body of business.
Thank you so much, Sophie. May I just say it's been a pleasure co-hosting these amazing events with you, Sophie. You're such a great collaborator and we work in great partnership. But we do have that TikTok challenge that I'm holding you to in that sort of sense. But absolutely, I'm the founder of L Factor. We help businesses grow. That's really basically it, whether it's in strategy, marketing, engagement, or relationship. So, and my middle name has always been collaboration. I believe in having a mutual growth where both businesses could be having mutual benefits, so to speak. But enough about me. Can I have the honor of introducing you to the most amazing, to the most charming and out of this universe, the dynamic duo of Steve and Claire, whom I met during a network event, and we've become very much collaborators, helping each other, and we've gained that momentum. So I thought, instead of keeping them to me, why not share them out to the whole Westminster Business Council? So without further ado, over to you, Steve.
Wow, thank you. As I said, going with a low promise and then better delivery. Right, hopefully technology is going to work here. Yeah.
I'll send you my invoice later, Steve.
Yes, thank you. Right, let me just see if I can share technology, or more to the point, the screen, hopefully.
Perfect.
Hopefully everyone gets surviving the pandemic, which after I wrote that down, I did think I should be telling you all to have like hundreds of batteries and cans of soup and tins of baked beans and a really sharp knife. But that's not really what it's all about, although the title is slightly misleading. So apologies for any survivalists who have come here hoping for those sort of hints and tips. So myself and Claire, as we've been massively egged up, are here just to talk to you guys about surviving the pandemic, but specifically from an insolvency practitioner's perspective, and then from a tax specialist perspective, so she can talk to you about all those helpful things like how to claim money and so on and so on. But so I'll introduce myself. Claire will then introduce herself, and then we'll get into the body of this chat. So as Lena has said, I'm Steve Iles. I'm a licensed insolvency practitioner and a partner in a firm called Anthony Batty and Company. I have a desk and a seat in the London office and the Croydon office, although I live sort of Croydon direction. So post all that's been going on, I've pretty much been working in Croydon to avoid going on the trains. I've been dealing with insolvency for just a little over 20 years, and prior to that 5 years sort of working in the banking side of insolvency. It's going to sound like I have this amazingly exciting varied career, because I've done sort of basic bankruptcies, high profile bankruptcies, and by high profile I mean people like Michael Barrymore and Neil Hamilton and Jonathan Aitken, and then I've dealt with Mr. Smith around the corner. I've dealt with the largest Ponzi scheme in the UK, and I'm also just dealing with the restructuring of a Chinese company which is moving its UK, or it's closing down an element of its UK operations. Now that last thing probably makes you think I must work for the largest firm in the world, but actually that's not the case at all. It's not about huge size in terms of insolvency practices. I'm going to hand you over to Claire so she can talk to you about herself, and then we'll get on with this.
Thanks, Steve. I'm not sure how I can compete with that intro. So hi everybody, thanks for coming along. I'd also just like to say a huge thanks to Lena, obviously, and WBC for hosting us. So I'm Claire. I'm a chartered accountant, chartered tax advisor based at a firm in Holborn in London called Elliott's. Our focus is small and medium sized businesses, but we do have some rather larger ones as well. I've also got 15 years experience in accounting, and that covers a wide range. So I've pretty much done everything you can think of. But recently I've decided to specialize in tax, so corporate tax and VAT, which I'm sure you can understand makes things interesting. Pass back to Steve.
Right. So agenda wise, so I'm in control of the buttons here, so Claire might occasionally shout at me. So we've done the introductions, dispelling some insolvency myths. I'm going to touch on directors' duties, and then obviously Claire's going to talk about government support, cash flow. Depending on how you guys are with questions, we might talk about case studies and round up and questions and all that sort of stuff. But as far as I'm concerned, if anyone's got any questions while I'm talking, just I don't know how practical raise your hand is, but shout or unmute, I think is what Sophie said. So should we'll get on, unless anyone has any questions already, that is. Awesome. Right. How's the sound? Is it feedbacking for everyone, or is it okay?
Perfect.
Okay, so it's me then. Right, so I thought it was helpful just to sort of dispel some myths, hence the title, and pretty much anyone I ever speak to and have spoken to, whenever something goes wrong in the world economy, the UK economy, everyone must go, oh, you insolvency practitioners, you must be delighted there's going to be a recession. And also they think that I'm some sort of vulture just hovering around, just waiting for the metaphorical business to die, rather than actually thinking about it in the broader sense, which, don't get me wrong, there are plenty of businesses which fail, but actually, as per the bottom or the first fact, do we love a recession? No, we do not. It's the worst time for us. It's the worst time for everyone. So I'm not going to go into it beyond saying it's rubbish, because who's going to buy assets that we're selling if businesses are failing? And that's the basic reason as to why we don't love a good recession. It doesn't do anything for anyone. The closing down and the last chance saloon are very much really one and the same in some respects, but the insolvency industry carried out a survey. It was a while ago now, and they're actually just running the latest round for 2019. So for 2018, there was a survey to sort of try and push on the positives of what happens, or the involvement of insolvency and how it can be positive. And as per the slide, 2 in 5 businesses that enter into an insolvency process are actually rescued. So there is an outflow of a business or part of a business after the event. And over 230,000 jobs were saved by the insolvency and restructuring industry in 2018. In terms of on a sort of personal individual side of things, the industry talked to I think it was 135,000 individuals had been given some form of support and advice through the industry, which allowed them to sort of restructure their personal financial difficulties. So it's not all about sort of the doom and gloom. It is there are success stories, I suppose, or positive outcomes that it doesn't fit the narrative, but they do exist. So that's all I was going to say about dispelling those myths. So I suppose I should have actually asked how many of the people here are sort of sole directors or joint directors of I'm going to assume just limited companies, but could be obviously LLPs. So what I've not thought about here is whether or not anyone is a sole trader. So where I say director's duties, what I'm talking about here is what you should be doing as a director of a company. If you think your business may or may not be in difficulty, you have what are called fiduciary duties, which is basically to any limited company is almost like a person in their own right. So you have to be mindful of, should that company, should that business incur this debt? Should this business transfer these assets? Should this business take deposits for work that maybe it won't be able to deliver? And one of the most obvious things to do is don't trade at the expense of the crown. So maybe someone might be going, well, what does trading at the expense of the crown mean? It means don't pay all your suppliers, but don't pay the revenue, because that's the crown. And also, and don't get me wrong, if I was to have some stats to hand, the revenue are the people that are on every single insolvency list of any single failed business ever. So don't get me wrong, there's a difference between owing the revenue a month's or a quarter's VAT return or not paying your most recent corporation tax. This is more around the whole prolonged, I haven't paid the revenue for 5 years type of, or certainly more than 1 year, let's put it that way. The things which are important for directors is you can make decisions and you can continue to trade if you think that the business might be in trouble. But what any prudent director or director should do is look to mitigate the potential risk that they would have. So it's not a surprise, I'm sure, to anyone that you want to be recording whatever decisions you make. And that's not, I decided to have a white coffee with 1 sugar this morning, but it might be, I'm going to spend £50,000 on a marketing campaign, or I'm going to buy a new van, or whatever it might be that is a sort of business essential decision. Now, either, or in the old-fashioned days, what would happen is you'd have a board meeting, there'd be minutes, and those sort of decisions would be recorded in the minutes, and that would be part of your sort of defence if anything untoward ever happened to the company and an insolvency process ultimately happened. You would be able to say to the insolvency practitioner, these are the decisions I made, this is the record of the decisions and why I made those decisions. Ties in with the obvious one, which is when you're making decisions, sometimes you're going to seek advice. So using a sort of example of a business has an asset, I don't know, a motor vehicle, let's say, and you decide to transfer that motor vehicle into your sole name and buy it from your own company, and you pay £1,000 for that vehicle. That there might not be anything wrong with that, but what you need to have is the advice or the evidence to show that that transaction was at fair value. So, okay, a print off of Glass's guide that shows that your 5-year-old van is worth whatever you've paid back into the business. It could also be solicitor's advice if you decide to litigate. It could be accountant's advice if you decide to do something around tax or VAT, and obviously Claire will be able to handle those sort of questions. I think it's fair to say that any creditor, any business, their own debtors, so people that owe your business money, may well be in difficulty as much as you might be in difficulty. So one of the things I would certainly suggest that directors are doing is talking to not only their creditors / their suppliers, but also to their customers, their debtors, to keep in touch with them, maybe agree payment terms that you wouldn't ordinarily do, but from your own business perspective, and this ties in again with what Claire will talk about in cash flow, I'm sure, is that you might actually rather get 20% of your invoice every month rather than 0%. So some of this is not rocket science in any way, shape or form. And then depending on ongoing trading and how your business operates, if it's a very much someone turns up, pays you money, you give them some widgets, then that's not necessarily something where you're going to have deposits and so on and so on. But if you have deposits, think about ring fencing them in a separate bank account. Pay for supplies going forwards from funds available. So don't make the bank position worse. Don't not pay the revenue from monies that you have to pay suppliers. And finally, just do the right thing, which is a very sort of trite thing to say in some respects, but just basically look at it this way, is if you were the business and you wanted, or more to the point, a better way of putting it, if you were approached by someone and they said, can you lend me some money? And then 2 days later, the business failed, would you be massively upset by that situation? Because if you would be, think about it from the perspective of, are you a director? Are you going to take supplies from a supplier? Are you going to borrow money from a bank? And then in a relatively short period of time afterwards, potentially could the business need to consider its position in terms of an insolvency process? And if the answer is yes to that, then my suggestion is that you need to think about whether or not you should really do that. But that's just a kind of very simple, straightforward way of doing it. And the same goes for the sort of loans and grants that are available. And again, Claire will touch on that shortly. Now that's me done for now on this, well, the lightest touch of techie insolvency ever. But if anyone's got any questions, feel free to raise their questions, or Sophie, I'm not sure if you're coordinating questions or something.
I have a question.
Okay, go on then.
You touched upon grants and loans. So I'm really interested to find out what happens if I've taken one of the loans or grants, etc. And subsequently, the business falls. But, you know, in the sense that when the business was trying to take out the grants or loans, it was because COVID happened. They wanted to have some sort of support, monetary sort of support to sort of cover the sort of COVID environment, etc. Yeah, and it just went, you know, because there was no customer, nothing as such. What does one do in that sort of environment? Right,
so it's kind of twofold. Part of it is proportionality. So if your business was, if I can say, solvent, maybe cash flow issues pre-COVID, but no concerns around the sort of viability of the business going forwards, then to be able to take the grants and loans is one. I mean, they were put there to help rescue businesses. So I don't think anyone in the government thinks that. I'm trying to think of an uber profitable business that just would take the money for no reason whatsoever. So it was very much about giving support to businesses. So I don't think anyone would be criticising a business that pre-virus was turning over, making some profit, not making profit every month, not necessarily even making profit every year, but was a viable business. And there are margins as to what is considered a viable business. If you have a business, and one of our case studies is about this kind of similar question, is if you have a business that has historically been unprofitable, and there are two tests for solvency. There's the balance sheet test and the paying your creditors test. The balance sheet test is, are your assets larger than your liabilities? So if you owe the revenue and everyone else £250,000 and your only asset are some book debts and stuff like that, money owed to the business, if those are valued at less than £250,000, then the the business is balance sheet insolvent. If it can't pay its debts, it's just somebody demands payment of their invoices. If you don't pay them or the business can't pay them, then on both counts, the business is insolvent. Now, if you've taken out £250,000, like I said just a minute ago, you've taken out £250,000 from the bank, whoever it might be, and then a month later you fold the business, there's a good chance that somebody somewhere will look at that transaction, an insolvency practitioner, and will then come back to the director and say, can you explain where this money has gone? If it was a £5,000 bounce back loan as an argument, they're going to look at that transaction and go, oh, well, it's not a lot of money. It's understandable from looking at the bank statements that they've paid some suppliers, they've paid some wages, whatever they've done with that sum of money, and probably there would be no further action because it's been sort of rightly spent. It's about sort of doing the right thing. And clearly there are shades of grey, don't get me wrong, too many to go into, but yeah, it's do the right thing.
Yeah.
Steve, we've got a question coming from Ian. He says, can you talk about owners who do a pre-pack and buy it back without the creditors?
I can do. I'm just thinking of time. Yeah, I mean, very, very, very simply put, and this is going to sound like I'm about to launch into like a 30-minute chat. The UK insolvency industry is structured in such a way that they encourage entrepreneurs, business rescue, whatever terminology you want to use. So the idea is that businesses that are run correctly, and I know people go, lots of these businesses aren't run correctly, but let's imagine that they all are. If the business fails and it's not down to sort of negligent directors, and again, there'll be question marks as to what consists of negligent directors, the best return to creditors is, generally speaking, to sell the business back to the existing management, because they have the most amount of information and therefore will make the best offer. Unless you're talking about, I'm trying to think of a good example of a business which has gone into admin and has been sold out to a competitor. I can't think of anything at the moment, because all of the big administrations that we've heard about, British Steel and all those sort of things, Debenhams, they're either continuing to trade and or they're bought out by a completely random business for substantially less money than what was ever owed to creditors. That's just unfortunately the way that the insolvency sort of legislation is written in the UK, or in England and Wales, I should say. It doesn't incorporate Scotland. That's very, very broad there. It was Ian, wasn't it, who asked the question, sorry. If you've got a specific set of scenarios or particular case in point, I'd happily have a deeper conversation about that afterwards or later on, if helpful.
Brilliant, thank you.
Over to Claire.
Okay, do you want to change the slide?
Go on then, there you go.
Okay, so I've got quite a lot to run through, so I'll do it quick, and then do stop me if you've got a question. So on your screen is a list of the support packages that have been brought in by the government, so some £200 billion worth of funding for individuals and businesses during the pandemic. I'm going to run through them. I'm not going to go into too much detail because a lot of them you'll already know plenty about, and I don't want to repeat that. But obviously do ask if there's something you want to know. There are a few on here that are new, that were announced at the summer statement. So for some of those, the detail isn't available. Ask your questions, but I might not know the answers because the answers might not be available just yet. So working down the list, we start with tax and VAT deferral. So VAT deferral's now ended. That ran up to the 30th of June. And if you did defer your payment, then you've got until the 31st of March 2021 to pay it back. On income tax, if you're self-employed, you've got an automatic deferral of your 31st of January payment that would be due in a few days' time. So you don't need to pay that, you don't need to ask for permission, and there's also no interest that accrues on not making that payment. So you don't then need to make it until January 2021. Corporation tax can also be deferred, but that's not automatic. So that you need to speak to the revenue. And you'd ask them for either a deferral or what they call a time to pay arrangement, which allows you to pay in instalments. They're going to expect some explanation of your figures and how you're going to be able to afford those instalment payments. So you need to be really well versed on your figures before you make that call. Moving down the list, next we've got the job retention scheme, or the furlough scheme. It's now closed to new applications, so I'm not going to mention any more about that. Business interruption loans. So we've got the CBILS for smaller businesses and the CLBILS for large businesses. Again, I don't want to go into too much detail. Just know that these are available. It's government-backed funding, but despite any good intentions from the government, they're not actually that easy to get hold of. There's also the bounce back loans, which are up to 50 grand for smaller businesses, and those are 100% guaranteed by the government. We've also got rates reliefs and grants. So again, most people are probably aware that local authorities were each given a pot of money to give out a grant to small businesses and those in the retail and hospitality sectors. It was down to the local authorities to make the decision as to who to pay and how much, although the government gave a guideline. So it will be down to your local authority as to whether you have got one or not. If you haven't received one and you think you should have done, then it's worth getting in touch. The job retention bonus. So this is one of the new measures. This is basically £1,000 is going to be paid to every employer who brings back a member of staff from furlough and then keeps them employed until the end of January 2021. There are some criteria on this. So there's a minimum amount they've got to pay, and of course they've got to keep them to the end of January. And for a lot of businesses, it's going to be a bit of a balancing act as to whether they keep the staff and pay them, but get the £1,000, or actually let them go. Stamp duty holiday. So if you have any dealings in property, this could be good news. So the threshold for stamp duty was increased temporarily from 125,000 to 500,000. So that's definitely got the property market going. Employer payments for job creation. So this is a bit of a broad brush statement. There are a number of new schemes that were brought in the summer statement. So there are payments for trainees and apprenticeships placements that are created, payments to the employer. There's also a new Kickstart scheme, which is for 16 to 24-year-olds. So that the government will pay the wages of eligible employees for up to 25 hours a week at minimum wage. The support for self-employed, so this was a scheme that was introduced, and it's now made 2 grants. The first, if you were eligible, was for up to 80% of your average profits to cover the 3 months up to June, and that was capped at £2,500 a month. The second is for 70% of your average profits. That covers the 3 months up to the end of September, and this time it's capped at £2,250 a month. VAT reductions, there's actually been a few. So we've got PPE, which was reduced to 0%, made sense. The ebooks VAT was, they brought forward the cut on that. So it was brought forward almost a year earlier than planned. So that's now 0% in line with physical books. And also we had the recent cut for hospitality and leisure sectors from 20% to 5% recently. Companies House, for those of you with limited companies, they've now automatically extended all deadlines by 3 months to give companies longer to file their accounts. Whilst initially that sounds like a good thing, it could also be a bad thing. So you might delay preparing your accounts or reviewing the position of the company, which might get the directors into some of the issues that Steve mentioned. Or you may also just not have up-to-date financials. So for lending purposes, which you need them, you might not have them available, or for your suppliers or customers, just to reassure them that you're viable to trade with. Finally, we've got the green homes or the green job scheme. So the idea behind this is to get homes more green, while at the same time creating work and jobs for those who undertake it. So your builders and plumbers and so on. So every homeowner, including landlords and buy-to-lets, will be entitled up to 2/3 of the cost of certain energy saving improvements on their homes, being done from September up to a maximum of £5,000. For those on low incomes, 100% of the cost will be covered by the government, up to a maximum of £10,000. Go to the next slide, please, Steve.
Sorry, computer says no. There we go.
There we go. Excuse me. Okay, has anyone got any questions on that before we move on then to cash flow? I realise I whizzed through that at speed.
Yeah, Claire, just a quick one. Can you remind us, with the £1,000 bonus for furloughed staff brought back?
Yeah.
So you received that £1,000. and then say you get to December and you think, actually, I just can't make it work for this person to stay, what happens then? Do you have to then give that £1,000 back again?
You would have to give it back, yeah, absolutely. I'm not entirely sure on. Yeah.
Sorry, I think the payment's actually going to be post January 31st.
I was going to say, I'm pretty sure the payments are going to be after.
It's going to be in February. Yeah, it's going to be in February. So, because we've already looked at this, and otherwise people are just saying they're going to delay, basically making people redundant, get the money, and then make people redundant for other reasons. But they're saying February before we can actually apply for the JRS scheme and get this £1,000 back.
Sure.
Cool, thank you. And also just one more, showing my ignorance. So say if you've booked a little stay in the UK a few months ago before the VAT reduction was announced, when you get to the venue to pay, the price that you pay should reflect that reduction in VAT, shouldn't it?
It's actually down to the supplier. So
right.
this is where I think I'm not sure the government necessarily has thought it through. So either they can say their prices are stated, it was VAT inclusive, there's less VAT, so they'll keep the difference.
Yeah.
Or they can decide to give you a refund based on the difference, so that they pass the saving on to the customer. Realistically, they should pass it on. So like you said, if you're going there, you'll pay a lower amount with less VAT, but it will depend supplier by supplier as to how they treat it.
Okay.
Also, from a holiday point of view as well, Sophie, is that if you prepaid that prior to the previous VAT return on a prepaid basis, then the sales already happened 3 months previous, so they've already done their prepayment to the VAT man, so they would have already paid the 20%. So effectively, you're going to have to pay the 20%. Now, if you do post departure, then the VAT element will be at time of purchase, which will be actually the day you check out. It should be at the 5%. Should be.
Yeah, that's correct. Yeah, the tax point will be when you paid it if you pay in advance, so it will be at the 20%.
Fantastic.
I was just going to say, to add into that, if any business was talking to me about this sort of thing, I would be saying, if you can get away with only paying 5%, but your customers don't ask you for a corresponding discount, you're going to do that. So I think most businesses will take it on a case by case, or more as a who's got the balls to ask the question by case basis, effectively. Sorry.
Thank you.
No worries. Okay, so if I move on now to cash flow hints and tips. I could probably spend hours talking over this topic. I promise I won't. I just thought it'd be useful to run through a few tips in these current times where cash is definitely king, and how your approach to managing your cash could be the difference between survival or ending up dealing with Steve. So firstly, maintain a cash flow and keep it updated. So you can't manage your cash flow if you don't have a cash flow summary. It may seem very simple, but I know so many businesses that don't have one, don't maintain one, and even if they once upon a time prepared a forecast, perhaps for a lending requirement, they haven't updated it. A cash flow summary is essential. It's a tool to manage your business. You need to prepare one to review your cash spend and include a forecast of everything that's coming in and everything that's going out, so that you can work out where things are going to get tight and where you might need to make some tweaks. Just using a bank account to monitor your cash isn't going to cut it, sadly, and certainly not in times like now. So my next point there is delay payments to suppliers. So this might be an obvious one, again, to some, but the longer you hold onto your cash, the more you can make it work for you. So you want to therefore put off your payments to your suppliers as long as realistically possible. I don't mean damage the relationships with them so that, you can't deal with them in the future and don't pay them until, months down the line. What I mean is, if they give you 14 days to pay it, pay on the 14th day. And then when you do pay it, think about paying it on a credit card with 30 days interest free, so that actually suddenly you've got your cash working for you for 44 days longer than you should have. And you can turn it into much more while, just utilizing your different options there. Of course, leaving it in your bank doesn't do anything for it. So when the cash is actually in your control, you need to do something with it. Invest it, buy stock, whatever it might be, but you need to do something with it and get a return on it. Credit control. So here we're talking about chasing your customers for payment. Nobody likes the task, And so many companies give extended credit without officially approving it, just by not proactively seeking payment. So bear in mind, your customers are going to do exactly the same to you as you're going to do to your suppliers. They're going to delay payment as long as possible. So if you let them, you could be waiting months to get any money in. So some things to think about here: you need to set terms with your customers, and you need to keep them. So if you say 7 days, you should be chasing them on the 7th day and telling them their credit's expired. It might seem like an expense that you can avoid, but it might be a sound investment to consider some external help for your credit control or some software to automate the process. Consider using statutory demands that aren't quite as expensive as going to court if things do get tricky. And also bear in mind, there is a statutory right to compensation and interest for late payment. Go back to my previous point on cash flows. Don't forget your forecast will be based on all of your customers paying on time. If they don't, and you don't chase them, that's going to mess up all of your forecasts. So your predictions and the position that you're supposed to be in won't be true. You're going to be forced into a position that's probably not good for your business, and you won't be able to pay your own debts as you need to. My next point on here: consolidate your debts or refinance. Again, this is a fairly obvious point here, but most businesses will have lending from several sources. You might have credit cards, loans, personal loans. Take the time to consider whether you can combine them into one loan that's more manageable, or you may be able to refinance and get better repayment terms. Bear in mind, Bank of England interest rates have fallen, so you might get a better rate, or you might be able to find some 0% interest available that will reduce your costs. It does, of course, depend on the terms of your lenders. You might be stuck in an arrangement that you can't get out of, so bear that in mind, but in any event, it's worth being on top of your debts. Maximise your grants and reliefs available. So again, fairly obvious, but have you considered getting a grant for the project you're working on? Have you checked if there's anything available? What are the tax reliefs, and have you discussed them all with your accountant or tax advisor? Something like a cash repayment from an R&D tax credits claim could give you the cash you need to get through. So I've got deferral or TTP, so that's time to pay for tax. So look to defer your tax or arrange a time to pay arrangement. The revenue are being more understanding now than ever about businesses in tough times, and they want you to survive. So it's easier than ever to get a deferral or an instalment arrangement. Be warned, you will need to demonstrate that you can meet the instalments and how much you can afford. So they're going to scrutinise your figures on the phone. So you need to have that cash flow summary that you've prepared handy and be able to answer all the questions to your numbers. You also need to make sure you call before your tax is due. Once you've gone past the deadline, they're not interested in helping you. They want to know that you're proactive and looking to sort things before you get to that crucial point. Moving on down my list then, so we're looking at current year losses. So unfortunately, if you've been affected by the virus, as so many people have, you may be facing a loss for the current financial year. Having a loss is bad enough, but then having to pay the tax on last year's profits is a real kick in the ass. So it may be better to use that loss to reduce the previous year's tax liability and therefore not have to pay as much tax now for last year. And again, the revenue are actually very open to that discussion. So if you can phone them and speak to them about your position, take them through what loss you expect, how that's going to affect your profits, you're going to do a carryback claim and it will reduce your profit for last year, you can reduce the amount you have to pay now on that basis before you've even got to the end of your financial year. Similarly, if you're a larger business, you might be paying payments on account for corporation tax. So bear in mind that your profits may have fallen, or you may be making a loss, and so you can reduce those instalment payments. R&D tax credits. So I touched on a bit earlier, but even if you're loss making, you can get a cash repayment from the revenue. So it might be worth you thinking whether you are eligible and just double checking, because that extra money can make all the difference. And finally on my list, I've got VAT. So if you've moved to a loss-making position, chances are you're in a repayment position on your VAT. So you're getting refunds from the revenue. Now, rather than wait 3 months and then file your VAT return, think about moving to monthly returns so you get that repayment quicker. So it's in your bank and you can use it, not in the revenues. And the last point on VAT, as with all recessions comes bad debts. If you've got bad debts, keep on top of them and watch that all important 6-month time limit when you can write it off and get the VAT back from the revenue. So that's the end of my slides for a minute. Pleased to hear. Has anyone got any questions?
Claire, I've got one. I'm really interested about the R&D tax credit. I'm an advisor to a couple of platforms, and some of them sort of like it's a startup company, but they haven't quite, you know, they're sort of testing out the algorithm, etc., and they haven't quite started trading yet. Could they still claim an R&D tax credit?
Yeah, absolutely. That's exactly what my study's about.
Oh wow!
You preempted it. Yes. So my case study, actually, I might as well tell you about that while I'm here. Was exactly that. So it was a startup. They were developing an app for your phones. They've actually been going for a few years now. So it's been about 4 years since they started developing it. But obviously it takes time, and you need funding from different sources. So things don't happen overnight. They still haven't made any turnover to date because the app's not in a fit state to sell. But they've been incurring costs. So they've obviously been raising funds, incurring costs. All of those costs have been eligible for R&D. And just this last financial year, we've put in a claim for £500,000 worth of costs, which has gotten £72,000 back in cash from the revenue. I think to date, they've had over £200,000 back from the revenue.
That's great. That's fantastic.
I've got a question, Claire, from Hani, who says, are there any VAT discounts for the service sectors, so not hospitality and restaurants?
No. Unfortunately, certainly no COVID special ones. There aren't, I'm afraid.
Worth asking.
Yeah, absolutely. You never know.
So I was just, Claire,
Yes.
can you hear me?
Okay.
How large, just following on from the question on the R&D, how large does a business have to be?
It can be as small as you like. It's literally any size. So there's 2 R&D schemes, one for SMEs, which is your very small businesses, and one for large companies. So any size company can claim R&D. I've had claims as small as about £2,000 in costs, but it's still cash back.
Yeah. Oh, super. All right. Thank you.
No problem. Anyone else with questions? Okay. Steve, do you want to do your case study?
Yeah, I was going to say, well, so yeah, so sorry, get my brain into gear. So one of the, unless anyone's got any other questions, we had the case studies, we've touched on the R&D one now. So I had one which I've called victim of the virus ? And it's more a set of circumstances that I was going to go through with you all, and then almost get like a show of hands or a what should it do, and I'd be interested to hear the feedback here. So what I can tell you about this business is that I started talking to them in August last year, and they were periodically making profits. So they'd literally have month 1 £5,000, month 2 minus £2,000. So not an awful position, but certainly balance sheet insolvent. I had a phone call from them on the 17th of March this year, which was I think just as furlough was just being announced as a potential opportunity, and I think maybe the other loans were sort of in the offing in terms of the Sybils and stuff like that. And the question that the business had to me, and I don't want to tell you the sector only because partly it probably gives it away as to what the answer is. But the question mark that was the questions that were asked of me were, right, we've been talking to you now for what was effectively about 7 or 8 months. should we look at doing furlough? Should we look at whatever facilities may or may not come up in the coming days and weeks? And it kind of feels like it was probably almost hourly. There was some new government scheme being introduced at the very beginning of this process. Now, if you guys can remember to what I was saying earlier about doing the right thing and not taking money if you weren't quite sure, I would be interested if anyone have any immediate thoughts on sort of what would, and I appreciate this is a very vague question, but what is the view of the group in terms of, would everyone take the money and hope for the best, or it would be interesting to hear what everyone else thought, and then I'll tell you what happened. I don't know if that's to put it in the chat box in terms of take the money and run, or other, and the other you can consider to be insolvency. Is anyone going to venture a guess?
I think most people would take the money in the hope that they could do something with it, and something better would be in the horizon for the next couple of months. I think if you see it as a lifeline, you grab it and probably worry about that later.
Yep, that's fair enough.
It also depends on the criteria. I mean, with different businesses, you know, I don't know what the criteria might be, etc. So definitely most of them are looking to get that support, money support, to sort of see what's possible out there, whether use it for marketing, etc. So yeah, I agree with Sophie.
I mean, what I would say, and sorry, it is a slightly unfair question because I know all the answers to all the questions and you guys are just being presented with these snippets. The other thing I should say, there were possible buyers, but they all pulled out at the time of the virus, unsurprisingly. So when I say to you that it was in the restaurant industry, so it was massively balance sheet insolvent. So whilst it was making a small amount of profit one month and a small amount of loss the next month, it sort of longer term picture was that it is basically a failing business. So the director, there were two directors, but basically it was the sort of husband and wife, kind of quite an atypical type of scenario. But this was like the wife's, what's the word I'm looking for? It was her baby. And that's why we'd been speaking in August, we'd been speaking in September, we'd been speaking in November, and she was always, I think I can sell it, I think it can kind of stay, my legacy will survive. On the 17th of March, when I spoke to her, the business had no money. The business had incurred additional debts in the run up to COVID. And basically it had no cash flow. So even if she had decided to go down the furlough route, she had no money to pay the staff to wait for the money to come back in anyway. So ultimately the business was placed into liquidation. And what I am hopefully going to imminently do is sell the business to complete the sale of the business. So it's partially rescued. The staff will go back and well, I won't say it's a great result because clearly if she'd been able to sell it early, it would have been a better result. But it's just about those fine margins. And that one was very fine as to whether or not you should say, take some money, pay the staff and see what happens in 3 months' time. I think ultimately she made the right decision, which was the restaurant's now been closed for 4 months. It can only just about reopen now, but we haven't finished the deal. So the business still hasn't traded. So thank you for participating in my kind of case study / Q&A, my own Q&A to you guys.
Steve, Hanny's written something which is just raised a question.
Yep.
When you go through insolvency, what sort of knock-on effect does that have for directors and their reputation? Is there anything that is sort of a stain against someone's ability to run a company? And can you comment on that at all?
So that's a good question. So in any, I should say, in a liquidation or an administration, the insolvency practitioner has to do has to report to the company director's disqualification unit, and we have to do a report on the conduct of the director or directors at the date of the insolvency. But also what we also have to include is any historic directors who have been in office sort of immediately preceding the insolvency, but also anyone who might be seen to be managing the business in a sort of shadowy, behind the scenes type of way. Now, you can, depending on what report we would give in to that particular team of the business innovation, or whatever they've now called it, it's the government department. It used to be Department for Trade and Industry so many years ago when I started, and I still think of it as that. There's a unit within that that department which effectively decides whether or not to try and disqualify directors. So if you have just the atypical directors, the business has been fine. Occasionally, it's sort of solvent. And it just basically COVID is the thing that pushes it over the edge. Assuming that you, as per my directors do's and don'ts, you've not taken money out of the business, you've not taken a load of deposits from suppliers, then you're never going to supply them with the widgets or whatever it might be. Then the likelihood is that there'll be no adverse finding for the directors, so they won't be disqualified. Would a bank perhaps look at a director's previously failed businesses? I think possibly some of them do. It's not something that I get involved in. And clearly, if you've banked with one bank and then you sort of roll up to the same bank the next day with your new company name, if for nothing else, they're going to put the two together, and that may or may not impact. But I think probably more often than not, a lot of these things are done by algorithms, so there isn't that kind of personal impact. So I don't know, but my feel is that probably the banks aren't that good at sort of putting two and two together, even though they're banks and they should be. Does that make sense? Any more?
Yeah, definitely.
Stephen, sorry, we've got a rather kind of not very nice client who, when we've done a bit more due diligence, has opened companies, closed them, and he's kind of got about 17 active directorships. And then he's got the same again in failed, well, I say failed, but closed businesses. When somebody comes to you with one company that is kind of insolvent, do you then look at other businesses that they potentially are directors in? Because for us, when someone knocks us for funds because they've closed one business, and they say, well, we've closed that, but they've got other businesses that are doing very similar, but just with a different name. Do you guys actually look at that and say, well, because you're in the similar kind of industry, or all you've done is you've, instead of changed company from company A, you're now called company B, but you're knocking company A clients for £100,000. Can you put limits or can you put restrictions on directors for that?
We as an industry don't. So the directors disqualification unit, so the CDDA reports that we do, that's controlled, that's effectively a government department. So they decide whether or not they are going to disqualify a director. In terms of, if a director, let's assume that a man or woman walks in off the street and says, I want to liquidate my company, and assuming I've had zero dealings with them previously, as you can imagine, I've got lots of boxes to tick and stuff like that. So one of the things I would look at is previous failures and stuff like that, but it's not for me in a sort of sense to judge what's gone wrong with the previous failures. What I didn't talk about in terms of the sort of work that I do is probably about, at the moment, probably over 50% of the work that I do is acting for the revenue where there's fraud and those type of scenarios. So the creditors as a body and as an individual, if you are owed a sum of money, do have rights, and the incumbent liquidator administrator should hear your concerns, and you should definitely raise those. And then depending on the precise set of circumstances, you might actually be able to take some proactive action. I mean,
we're not interested in getting the money. Basically, we're interested in make sure he can't carry on going like this, and he gets banned from being a director. Yeah,
it depends what he does. If he dissolves the companies rather than there's ever an insolvent liquidation, then dissolution never results in a company director's disqualification report, because disillusionment is a sort of, theoretically you're only supposed to do that if the business has no assets, has no liabilities, and it's effectively just ceased to trade. So it's if you've got like a specific thing, I mean, maybe we can talk about it and I can give you some hints, because there are people you can complain to, and I act for some institutional creditors, so people like some lease finance companies. So if they feel
we can take this offline, and actually we'll take this of another conversation. Yeah, for sure.
Yeah, no, I think that's probably the best idea. Any more, Sophie?
Yeah, we just had couple of quick ones. Ian says, are you able to say anything about the employer pay for job creation?
Claire, that's you then.
Claire.
Okay, so just a bit more detail than what I already said, I guess. So you've got the Kickstart scheme, which is for 16 to 24-year-olds, and they pay for 6 months, minimum wage up to 24 hours a week. For trainees, there's £1,000 per trainee placement created. Not sure on the details behind that yet, but it's £1,000 per trainee. Apprentices, so it's essentially the scheme they had before a while back, a little bit enhanced. So it's £2,000 for any young apprentice and £1,500 for any apprentice 25 and over is paid to the employer for creating those jobs.
Wonderful, thank you. And just another couple. Can you still claim for R&D if the company was dormant?
It depends what you mean by dormant, because if you're incurring expenses, you can't be dormant. If you mean you haven't got any income yet, so you haven't got any turnover, then yes, you can. You have to meet what we call a going concern requirement, so you have to be able to prove that you are feasible to continue in the future. So with the startup I mentioned earlier, they hadn't got any turnover yet, but they were developing something that would make sales, and their forecast therefore proved that they were a going concern in the long term. If you're a company that's ceased to trade, but you're still incurring expenses, then it might be a trickier situation. And certainly once you're in administration or liquidation, you can't claim R&D anymore.
Yeah, that makes sense. And another quick one, when dormant, do you wait for revenue coming in before switching to active?
So it's more the other way around. So if you're a dormant company, you're supposed to notify the revenue that you are now active and trading. Active and trading. So you might be registered with the revenue as dormant, so they don't ask you to file tax returns. And as soon as you start to trade, you're supposed to notify them so that they know to bring you in and charge to tax.
Perfect, very clear. Thank you very much. I think that's it from questions from us.
I was going to say we had this final slide, but I know that we're obviously past our 4 o'clock slot. So there you go, there's Claire, and there's me, and that's the end. So unless anyone's got any more questions, thank you for your time all.
Brilliant. Thank you both very much. That hour just flew by, but I really appreciate all of your insights. I know it's been a hell of a few months for everybody, but what we're going to do after this session is we'll share Steve and Claire's contact details. So if you do have some pertinent questions or anything that you need assistance on, I know they're very, very approachable and be more than happy to help. So we'll share their contact details. So that just leaves me to thank them both for their time and for presenting, and thank all of you for logging in and joining us, getting involved with the discussion, asking lots of really interesting and insightful questions. Please look out for more events from Westminster Business Council. They'll be coming through your virtual letterbox shortly, so do look out for them, and stay safe, and we'll see you all soon. Thanks very much.
Thank you. Bye.
Take care, everyone.